Today, we're breaking down exactly how the 2026 Iran-Israel-US conflict is setting off a massive chain reaction, one that's going to make everyday life a whole lot more expensive for all of us. We are right in the middle of a truly unprecedented geopolitical event, and we need to map out the sheer scale of the economic fallout. We're going to trace the path from military maneuvers in the Middle East straight to your local grocery store and your utility bills, and unpack the hidden systems connecting global energy markets right to your wallet. Let's get into it.
So let's kick things off with a massive number, 20%. That is the share of the entire world's daily oil supply plus a huge chunk of global liquefied natural gas that normally flows right through the now-closed Strait of Hormuz. We're talking about a tiny but incredibly strategic waterway that acts as the central artery connecting Gulf energy producers to the rest of the planet. And when you suddenly sever 20% of the global supply of the most heavily traded commodity on Earth, the shockwaves are absolutely instantaneous and they are brutal.
Because this geopolitical bottleneck, it isn't just a military event. It literally represents the severing of the most critical energy vein on the planet. The International Energy Agency is actually calling this the greatest energy security challenge in history. We're looking at an estimated 13 million barrels of oil per day that are just stuck. To put that into perspective, the global economy simply doesn't have the spare capacity or the alternative pipeline routes to replace that insane volume of energy overnight. It's just not possible.
And well, the immediate market panic was absolute. The second that strait was closed, the global benchmark, Brent crude, surged an astonishing 84%, shooting way past $120 a barrel. I mean, when the market realizes that roughly a fifth of its daily lifeblood is suddenly trapped behind a maritime blockade, prices don't just climb, they explode. And as we're going to see, that raw commodity cost, that's really just the very first domino to fall.
Now you might be wondering, how do these global commodity spikes actually translate to your morning commute? The answer is painfully. We've already watched the national average jump over $4.10 a gallon, and projections are warning it could easily breach $5 if this blockade keeps up. In California, we've even seen extreme highs nearing $9. That turns a basic trip to the grocery store into a literal financial hurdle. S&P Global estimates that if these sustained high prices hold, it's going to drain roughly $100 billion from U.S. consumer purchasing power this year alone. That's a massive, immediate tax on everyday life.
Okay, so we all see the pain at the gas pump, right? But how exactly does a conflict in the Middle East drive up the price of the food sitting on your kitchen table? I mean, it's pretty easy to understand why gasoline gets expensive when oil is blocked. But the real shock lies in the invisible, highly energy-intensive networks that literally feed the world.
Here's how that hidden domino falls. Energy is the foundational building block for absolutely everything. First off, roughly 20% of global liquefied natural gas, or LNG, is currently stranded in the Gulf, and natural gas happens to be the primary raw material used to produce ammonia-based nitrogen fertilizers. So with LNG trapped, fertilizer production just stalls out. In fact, we saw the price of urea, which is a really critical solid nitrogen fertilizer, surge 32% in just 1 week. Higher fertilizer costs directly threaten farming yields and operating costs globally, and that guarantees higher grocery prices for all of us in the coming months.
And for the nations right at the epicenter, this crisis is already existential. The immediate humanitarian and economic impact on the Gulf states is staggering. Because of the blockade, up to 70% of the region's food imports have been completely disrupted. Retailers are literally having to airlift basic staples into the region just to keep their grocery shelves stocked. This logistical nightmare has triggered a massive 40 to 120% spike in consumer food prices over there, which really offers a grim preview of the severe supply chain shocks that are rippling outward right now.
So this combined energy and food shock introduces a total nightmare scenario for global central banks, a little thing called stagflation. Stagflation is an incredibly toxic economic brew. It happens when an economy basically stops growing, it stagnates, but the cost of living just keeps skyrocketing because of inflation. For the economists who manage the world's money, it's the ultimate double bind. Why? Because the cure for one symptom usually makes the other one much, much worse.
Central banks, like the European Central Bank and the U.S. Federal Reserve, are now caught in this vicious trap. Think about it. If they raise interest rates to cool down inflation, they risk pushing a fragile, energy-starved economy into a deep recession. But if they choose to hold or cut rates to stimulate growth, well, they allow that energy-driven inflation to just run red-hot, completely devastating household purchasing power. Honestly, there's just no easy way out of this.
And the European Central Bank's recent 2026 revisions highlight this exact bind. The ECB has been forced to raise its inflation forecast to 2.6%, which is well above their 2% target, and that's largely driven by these energy shocks. But at the exact same time, they've had to downgrade their economic growth forecast to a super sluggish 0.9%. It is a textbook case of stagflationary pressure. Prices are climbing right over the target, while economic output is just grinding to a halt.
This macroeconomic panic brings us to our final domino, the reality for the everyday consumer. People are acutely feeling the pinch, and they are rapidly losing hope. As Joanne Hu from the Surveys of Consumers and economist Heather Long point out, no amount of positive economic spin works when people are staring at $4 or $5 gas at the pump. Everyday citizens are bearing the brunt of this geopolitical standoff, and consumer sentiment is locked directly to the reopening of that narrow shipping lane in the Middle East.
And you know what? The data completely backs up this pessimism. Take a look at this number, 49.8. That represents the University of Michigan's Consumer Sentiment Index crashing down to a record low. We are talking about a level of financial misery and anxiety that hasn't been seen since data collection began all the way back in 1978. It shows that across all demographics, doesn't matter your age, your income, or your education, people are incredibly anxious about their shrinking purchasing power. The shock isn't just in the markets, it's deeply psychological and it is widespread.
The harsh reality here is that whether you're flying, driving, or honestly just trying to eat, this geopolitical bottleneck is siphoning money directly out of your wallet. We're seeing household energy costs projected to jump by hundreds of dollars annually. Airlines are already passing the soaring cost of jet fuel onto passengers through higher fares and, yep, those ever-present baggage fees. Long-term consumer inflation expectations have hit a 3.5% peak. And tragically, low-income households who already spend a much larger percentage of their income on basic energy and food, they're bearing a disproportionate and absolutely devastating burden. All while major fossil fuel producers are inevitably raking in massive, crisis-driven profits.
Which really leads us to the ultimate question. Despite decades of climate promises and investments in green transitions, this crisis proves our absolute vulnerability to fossil fuel choke points. A single conflict on the other side of the world literally has the power to dictate the cost of your groceries and the entire trajectory of your national economy. It leaves us to wonder when, or even if, everyday affordability will ever return. And more importantly, what is it going to take for the global economy to finally break free from this fragile, volatile tether? Thank you so much for joining me for this explainer.